If you checked precious metals prices this morning and felt your stomach drop, if you saw red numbers flashing across your screen and immediately thought about selling, then what I'm about to share with you might be the most important market analysis you encounter all year. Because what's happening right now in silver and gold markets isn't what it appears to be on the surface. While your screen shows prices crashing, the actual physical metal market is telling a completely different story. And understanding the gap between these two realities could be the difference between making a devastating mistake and recognizing the opportunity of a lifetime. Before we examine the data, let me be completely clear about something important. Nothing presented here constitutes financial advice or recommendations to buy or sell any securities or commodities. This is educational market analysis based on publicly available data and historical patterns. All investments carry substantial risk, and you should consult qualified financial professionals before making any investment decisions. What follows is data interpretation designed to help you understand market mechanics that aren't widely discussed in mainstream financial media. Let's start with what happened overnight, because the price action was dramatic enough to cause genuine panic among investors. Silver prices fell from above $120 per ounce to below $90 in approximately 24 hours. That represents roughly a 25% decline in a single day. Gold experienced similar selling pressure, falling significantly from recent highs. To anyone watching these charts, this looks like a complete market collapse. It looks like the bull market is over, and everyone who bought precious metals made a terrible mistake. But if you stop looking at the price ticker and start examining what's actually happening in the physical delivery markets, you'll discover something that completely contradicts the narrative that prices are telling. Today is January 30th, 2026. It's the last trading day of the month and the last trading day of the week. More importantly, for futures markets, today marks what's called First Notice Day for February contracts. For those unfamiliar with futures market mechanics, let me explain why this day matters so much. First Notice Day is when futures contract holders must make a decision. They can either roll their position forward by selling the expiring contract and buying a later month, staying in the paper market, or they can stand for delivery by doing nothing and legally demanding that the exchange deliver physical metal to them. Usually when prices crash right before First Notice Day, it's designed to scare contract holders into rolling forward rather than taking delivery. The expectation is that falling prices will cause panic and people will exit their positions. But something extraordinary just happened that defies this typical pattern. Despite the price crash, despite the fear, despite the selling pressure, the delivery volume that just hit the market is absolutely massive. The official data from CME Group, which operates COMEX futures markets, shows something remarkable. For the February gold contract, 20,484 delivery notices were issued on the first day. Let me put that number in context because the scale is important. A standard gold futures contract represents 100 ounces. So 20,484 contracts equals 2,048,400 ounces of gold. That's approximately 63 metric tons of physical gold that just changed hands in a single day. Think about the psychology of what just happened. The price is crashing. Fear is everywhere. Mainstream media is writing articles about bubbles bursting. And yet entities holding these contracts looked at the falling price and said they still want the physical metal delivered. They're not scared by the price drop. They're not convinced the bull market is over. Instead, they're demanding delivery of 63 tons of gold at the exact moment the price is falling. This tells you something profound about what sophisticated market participants actually believe versus what the price chart is showing. Now let's examine who is on each side of these deliveries because this reveals the mechanics of what's happening. The data shows that major banking institutions are the primary issuers of delivery notices, meaning they're the ones who have to provide the physical metal. One major institution issued approximately 12,000 notices, representing roughly 1.2 million ounces of gold leaving their vaults. European banking institutions also issued substantial delivery notices, with multiple banks each delivering over 2,000 contracts worth of physical gold. Here's where it gets interesting from a market structure perspective. Some of these same institutions are simultaneously on both sides of the trade. They're issuing notices on some accounts while stopping for delivery on others. This creates enormous volume that might look like normal market activity, but it's actually the same institutions moving metal between different accounts and different clients. The net effect is that vaults are being drained. Physical gold is leaving the exchange system. And this is happening during a price crash, which is the opposite of what should occur in a normal functioning market. If you're finding this structural analysis valuable, please leave a comment with your thoughts on what's happening. Engagement helps this content reach more people who need to understand these market dynamics. Also consider subscribing, because the follow-up analysis on how this situation develops will be crucial for anyone trying to understand precious metals markets. Historically, on first notice day, you might see 2,000 to 3,000 contracts stand for delivery. Seeing over 20,000 contracts is a 10 standard deviation event, a black swan occurrence that indicates the normal mechanisms of futures markets have failed. The futures market is designed to discourage physical delivery through cash settlement incentives and margin requirements. When delivery volume reaches these levels despite a crashing price, it proves the paper pricing mechanism is completely disconnected from physical demand. Let me explain what this disconnect means in practical terms. Imagine walking into a luxury car dealership and seeing a sign advertising 90% off all vehicles. Then imagine seeing a line of wealthy buyers extending around the block, all demanding immediate delivery despite the sale price. The discount isn't scaring them away, it's attracting them. This is essentially what's happening in gold markets right now. The price discount isn't reducing demand, it's increasing it among those who understand the real value. But if the gold market is showing stress fractures, the silver market is experiencing something even more extreme. While gold had massive delivery volumes, silver had a price collapse combined with something unprecedented. When the price crashed to $90, rational investors worldwide had the same thought to buy the dip. If silver was attractive at $120, it should be even more attractive at $90. But when investors tried to act on this logic, they discovered something shocking. They couldn't buy. Multiple major precious metals dealers went offline during the price crash. Websites showed error messages. Some displayed notices about scheduled maintenance. Others simply wouldn't load. The timing was remarkable. At the exact moment when demand to buy physical silver should have been overwhelming, the infrastructure to purchase it became unavailable. This wasn't isolated to one dealer. Reports indicate multiple major retailers experienced similar issues simultaneously. Now, scheduled maintenance can happen at any time, but the probability that multiple independent dealers would all schedule maintenance during the most volatile trading session in years strains credibility. The more logical explanation is that dealers recognized they couldn't handle the demand at $90 prices. If they left their systems operational, they would sell out their entire inventory within minutes to buyers recognizing the discount. And with chaotic market conditions, dealers couldn't adequately hedge their exposure through futures markets, so systems went offline. Not due to technical problems, but due to economic reality. This wasn't limited to American dealers. Reports from London indicate that the London Bullion Market Association experienced technical difficulties with their electronic matching systems at the same time. This effectively locked out Asian buyers who were positioned to purchase significant quantities. By disrupting the connection between Eastern buyers and Western sellers, the selling pressure could continue without meeting the buying demand that exists at these lower price levels. Think about what this reveals about market structure. When prices rise, exchanges raise margin requirements to limit buying. When prices fall, websites go offline to limit buying. The system is designed to control access in both directions. This is why understanding these mechanics matters more than watching price tickers. The price you see on your screen only matters if you can actually transact at that price. If you can't buy when prices are low or sell when prices are high, the posted price is meaningless. Now let's examine why this crash happened on this specific day, because timing in markets is rarely coincidental. Today is January 30th, the last trading day of the month. This matters because large financial institutions must mark their positions to market at month end for regulatory reporting. If silver closes the month at $120, banks holding short positions show large unrealized losses on their books. Their capital requirements increase. Risk managers escalate concerns. But if the price can be pushed to $90, even temporarily, even just for the month-end close, those losses disappear on paper. Risk ratios look healthy. Regulators see compliance. This practice is called window dressing. It's marking positions at artificial levels to create favorable reporting. The price doesn't crash because fundamental value changed. The price crashes because institutions need to paint a specific picture for month-end reporting. This has happened repeatedly throughout financial market history across different asset classes. After approximately 3 minutes of analysis, you might be wondering how to think about your own positioning during this volatility. Let me shift perspective here to discuss what this situation reveals about the difference between paper markets and physical markets, because understanding this distinction is crucial for making informed decisions. The price you see on COMEX futures in New York is determined primarily by paper contracts. These are agreements to buy or sell silver at future dates, but the vast majority settle in cash rather than physical delivery. This allows the paper market to grow far larger than available physical supply. Traders can control $100,000 worth of silver with only $5,000 to $10,000 of margin due to leverage. This leverage amplifies price movements in both directions. When margin calls hit during a price decline, forced liquidation creates cascading selling pressure. Algorithms detect the momentum and add to selling. Stop-loss orders trigger automatically. This creates a spiral where selling begets more selling, regardless of underlying physical supply and demand fundamentals. The paper market can experience extreme volatility based purely on leverage dynamics and position liquidation, but the physical market operates on completely different principles. Physical buyers need actual metal for industrial use, investment, or central bank reserves. They can't settle in cash. They need deliverable ounces. And right now, the physical market is showing extreme tightness that contradicts the paper price collapse. Let's examine the global price divergence because this reveals the crisis in market structure. While COMEX silver trades at $90 in New York, Shanghai silver is trading at approximately $136. That's a $46 premium, representing roughly a 51% premium over the COMEX price. This is the largest Shanghai premium in the history of modern silver markets. Physical silver in China is trading 51% above paper silver in New York. In normal market conditions, premiums between global markets for the same commodity are typically 1 to 3%, representing transportation, insurance, and minor regional imbalances. When premiums reach 5 to 10%, it indicates supply tightness. 15 to 20% suggests serious shortage. A 51% premium is unprecedented. It tells you that physical buyers in Asia are desperate to acquire metal and willing to pay massive premiums over paper prices to get it. Think about the behavioral economics of the situation. These are sophisticated buyers with access to the same price data you see. They could wait for lower prices if they believed COMEX accurately reflected value. But they're not waiting. They're paying $136, a 51% premium, to secure physical delivery immediately. Why would rational economic actors do this? Because they don't believe the COMEX price is real. They believe it's a paper fiction maintained through derivatives and leverage that will eventually break. And when it breaks, physical metal won't be available at any price. This isn't the first time we've seen paper and physical prices diverge, but it's the most extreme divergence in modern market history. To understand the significance, we need to examine historical precedents. In March 2020, during the initial COVID panic, gold premium spiked to approximately $100 per ounce over spot prices in some markets. That was considered extraordinary. Physical dealers couldn't get inventory while paper prices were actually falling. The divergence lasted several weeks before resolving through paper prices rising to meet physical demand. In the silver market specifically, we saw significant premiums in early 2021 during the retail buying surge. Physical silver coins and bars were commanding 20 to 40% premiums over spot prices. But even those historic premiums pale in comparison to what we're seeing now. A 51% premium sustained across an entire major market like Shanghai isn't a temporary dislocation, it's a structural break in the pricing mechanism. What makes this different from previous premium spikes is the scale and duration. We're not talking about retail coins carrying premiums due to minting capacity constraints. We're talking about wholesale market prices, 1,000-ounce bars, industrial quantities, all trading at massive premiums over the supposed global benchmark price. This suggests the benchmark itself is broken. Historical analysis of commodity markets shows that when physical and paper prices diverge beyond certain thresholds, the divergence resolves violently. It doesn't gently converge over time. What typically happens is paper prices remain suppressed until a delivery crisis forces rapid repricing. The Hunt Brothers silver situation in 1980 provides lessons here. When physical delivery demands exceeded available supply, prices didn't gradually adjust. They spiked violently as shorts scrambled to cover. The current situation has similarities, but also critical differences. In 1980, the delivery pressure came from a concentrated group attempting to corner the market. Today, the delivery pressure is coming from geographically distributed demand across Asia, Middle East, and other regions. It's not manipulation, it's genuine supply deficit meeting strong demand. This makes the current situation potentially more explosive because there's no single actor that regulators can target to relieve pressure. Consider also the historical context of Chinese precious metals accumulation. For the past 2 decades, China has been systematically accumulating gold and silver, both at the government level through central bank reserves and at the citizen level through retail investment demand. Chinese gold imports through Hong Kong have totaled thousands of tons over the past 15 years. This metal has flowed east and not returned. It's been accumulated and held. The same pattern is now accelerating in silver. Chinese industrial demand for solar panels, electronics, and electric vehicles consumes enormous quantities of silver annually. But on top of industrial consumption, investment demand has surged. Chinese citizens have experienced currency devaluation, property market instability, and stock market volatility. Precious metals represent stability and wealth preservation outside the banking system. When you combine industrial consumption with investment demand and add a government policy that restricts exports, you create a one-way flow. Silver flows into China and doesn't come back out. The Shanghai premium isn't temporary arbitrage, it's the market price adjusting to reflect permanent shifts in global supply chains. Western sellers are discovering they can't easily access Chinese buyers due to export controls. Western buyers can't easily import from China due to the same controls. The markets are fragmenting geographically. India shows similar dynamics. Mumbai silver is trading at approximately $118, a $28 premium over COMEX. London physical markets show premiums over COMEX paper prices. The entire global physical market is trading at significant premiums over the New York paper price. This creates an arbitrage opportunity that should close immediately in efficient markets. Traders should buy COMEX paper at $90 and sell physical in Shanghai at $136, pocketing the $46 spread. But this arbitrage isn't closing. Why not? Because you can't easily convert COMEX paper into Shanghai physical. The paper market is effectively disconnected from the physical market. You can't take delivery from COMEX and immediately ship to Shanghai fast enough to capture the spread due to settlement times, shipping logistics, and refining requirements. The markets are separated by friction that prevents normal arbitrage from functioning. This separation allows paper and physical to trade at vastly different prices, and it reveals which price is real. If you need actual metal, you pay the physical price. If you're just trading paper contracts, you accept the paper price. The physical price represents real supply and demand. The paper price represents leverage and forced liquidation. Now let's examine another critical data point that reveals who's behind this selling pressure. In normal market crashes, when prices fall 15 to 25% in a day, it triggers a feeding frenzy. Short sellers pile in, borrowing shares to sell them, betting on further declines. The cost to borrow shares typically skyrockets during crashes because everyone wants to short. But something strange is happening in silver exchange traded funds right now. The borrow fee for shares of the largest silver ETF is sitting at approximately 0.53%. That's essentially free. That's rock bottom. And there are over 10 million shares available to borrow, sitting unused. Nobody's borrowing them. Nobody's shorting despite a massive price decline. This is highly unusual. It tells you that sophisticated speculators are refusing to bet against silver despite the crash. Why? Because they're looking at the same global premium data we just examined. They see $136 in China, $118 in India, $90 in New York. And they know that shorting at 90 when physical trades at 136 is extremely dangerous. If the gap closes through New York prices rising rather than Shanghai prices falling, anyone short gets destroyed. The smart money is staying away from the short side despite the crash. This tells you the selling is concentrated among a small number of entities, likely major banks that need to manipulate month-end marks, rather than broad-based market participants betting on further declines. Even more remarkable, some of these same institutions that are selling are simultaneously publishing research, calling for much higher prices. Major banking research departments are putting out price targets for gold at $8,500 per ounce, representing approximately 63% upside from current levels. Their reasoning is based on increasing allocation from institutional investors moving from traditional assets into hard assets. Think about this disconnect. The trading desk is selling, smashing prices lower. The research desk is telling wealthy clients to buy because prices are going much higher. This isn't confusion, it's strategy. The institution knows prices are going higher long term, but they're using the paper market to create fear and shake out weak hands, allowing them to accumulate physical at discounted prices before the inevitable rise. This is a classic shakeout pattern. Price is driven below support to trigger stop losses, create panic, and generate the liquidity needed to build large, long positions. They're not selling because they believe the asset is worthless. They're selling to create the opportunity to buy more at better prices from frightened retail investors. Let's examine the junk silver situation because it reveals additional stress in the physical market plumbing. Constitutional silver, the pre-1965 American coins containing 90% silver, typically serves as the most liquid form of physical silver in retail markets. But in recent days, major refineries have stopped accepting it. They're overwhelmed with industrial demand and demand for pure bullion, so they told wholesalers to stop sending bags of old coins because they take too long to process. This created a bottleneck. Local dealers accumulated constitutional silver from public sellers but couldn't move it to refineries. This froze their capital. When dealers run out of cash, they can't buy from the public, eliminating the bid. The plumbing backed up. This was exactly what sellers of paper wanted to create illiquidity in physical markets to amplify the panic. But then private capital stepped in. Wealthy individuals who don't need dealer websites recognize the opportunity. When dealers are drowning in constitutional silver they can't sell, and when prices are crashed, sophisticated buyers purchase entire positions at discounts. This clears the blockage, provides liquidity to dealers, and allows the market to function again. This intervention reveals an important principle. The paper market can be manipulated. Websites can go offline, but they can't stop all buying. They can't prevent private wealth from recognizing value and stepping in when prices are artificially suppressed. Every attempt to lock down the market creates opportunities for those with capital who understand what's happening. Understanding the mechanics of how markets actually function during these stress events is crucial for making informed decisions. Most retail investors have never experienced a true market dislocation where paper and physical completely divorce. They're accustomed to looking at a price quote and assuming that's the price they can transact at. But markets don't work that way during stress. Liquidity is often described as the ability to buy or sell an asset without affecting its price. But true liquidity means more than just tight bid-ask spreads on an electronic screen. True liquidity means you can actually complete transactions at posted prices and size. When websites go offline, when dealers stop answering phones, when delivery delays extend from days to weeks to months, you're discovering that the liquidity you thought existed was an illusion. This is why understanding the difference between paper claims and physical possession matters so much. If you own shares of an exchange-traded fund, you own a claim on metal held in a vault somewhere. That claim is only as good as the institution's ability and willingness to honor it. If the institution faces delivery demands it cannot meet, or if regulators change rules about redemptions, your claim might not be honored as you expect. Physical possession eliminates counterparty risk. If you hold physical metal outside the banking system, you're not dependent on anyone else's promises. You can't be locked out by a website going down or a rule change. This is why premiums for physical are expanding. Buyers are paying for the certainty of possession versus the uncertainty of paper claims. The current market structure also reveals important lessons about how modern financial markets are designed. They're designed for efficiency during normal conditions, allowing rapid transactions at low cost through electronic systems. But they're not designed for stress. When everyone tries to move in the same direction simultaneously, the systems break down. Circuit breakers trigger, trading halts occur, websites crash, margin requirements spike. These aren't accidents or technical failures. They're features built into the system to prevent disorderly markets. But from an individual investor perspective, these features mean you can't always access your capital when you most need to. You can't buy when prices are crashing if systems are offline. You can't sell during flash crashes if circuits are broken. You're at the mercy of the system's rules and the institution's decisions about when to allow transactions. This is particularly relevant for precious metals because they serve as insurance against system failure. People buy gold and silver as protection against currency debasement, banking system instability, and economic crisis. But if your access to those insurance assets is controlled by the same system you're trying to insure against, the insurance is compromised. This is why informed investors are increasingly focused on physical possession rather than paper exposure. The current price action is also teaching lessons about volatility and position sizing that are universally applicable across markets. 25% daily moves are emotionally devastating if you're over-leveraged or if your entire portfolio is concentrated in one position. Leverage amplifies returns in both directions, and during violent moves, leverage can completely wipe out accounts through margin calls regardless of whether your long-term thesis proves correct. Proper position sizing means having exposure that allows you to sleep at night, even during maximum volatility. If a 25% decline in one day causes you to panic and make emotional decisions, your position is too large. If you're checking prices every few minutes and feeling your heart rate spike with each refresh, you're overexposed. The goal should be to have conviction in your thesis and position size that allows you to maintain that conviction through inevitable volatility. This applies equally whether you're trading paper or holding physical. If you bought physical silver as long-term insurance against currency debasement, a temporary paper price decline shouldn't change that thesis. The fundamental reasons you bought haven't changed. But if you're checking the price obsessively and feeling anxiety, it suggests either your position is too large or you haven't fully committed to the long-term thesis. For traders using leverage, these volatile periods are when accounts get destroyed. A 25% move against a 5 times leveraged position means you've lost 125% of your capital, more than your entire account. Margin calls trigger. Positions get liquidated at the worst possible prices. And you're left with nothing, despite potentially being right about the long-term direction. This is why successful long-term investors generally avoid leverage in volatile assets. They size positions conservatively. They think in years, not days. They use volatility as opportunity to add to positions rather than as reason to panic. The investors who will profit most from the current situation are those who recognized value, sized appropriately, and have the emotional discipline to ignore short-term noise. Now let's discuss the most important question. What should you do with this information? You have 3 different realities to choose from right now. Reality 1 is the New York price. $90 silver, artificially suppressed paper price set by leverage and forced liquidation, not reflective of physical supply and demand. Reality 2 is the global physical price, $118 in London and India, representing fair value where physical metal actually changes hands. Reality 3 is the China price, $136, representing desperate demand with zero inventory. The tragedy of this moment is that millions of Western investors are looking at Reality 1 and making decisions based on it. They see the crash and they panic, they sell. And who buys their metal? Reality 3 buys it. Every time someone sells because they're scared of the New York price, an Asian entity buys that metal and ships it east. You're not just losing money on the trade. You're transferring generational wealth to buyers who understand that the paper price is fiction. The spread between these markets, this massive gap, is the first crack showing that COMEX and LBMA are losing control of price discovery. They can smash paper prices, but they cannot smash physical demand. If they keep prices at $90, vaults will empty faster because low prices attract buying, especially when global physical prices are 50% higher. Low prices cure low prices by destroying supply through increased demand. Here's the critical framework for thinking about this situation. Don't let a temporary decline in paper markets shake you out when the physical market is screaming the opposite message. If sophisticated Asian buyers are paying $136, why would you sell at $90? If major banking research departments are targeting $8,500 gold, why would you sell at current levels? If delivery volumes are hitting record levels during price crashes, what does that tell you about real demand? Use the manipulation to your advantage if you understand what's happening. If large institutions want to subsidize your purchases by temporarily crashing paper prices while physical remains tight, that's an opportunity, not a crisis. But this window won't remain open indefinitely. Eventually, arbitrage will reassert itself. Eventually, physical shortages will force paper prices to converge with physical prices. And when that convergence happens, it won't be physical falling to meet paper. It will be paper rising to meet physical. Let me give you 3 key takeaways that synthesize this analysis. Number 1, the delivery volumes hitting COMEX during this price crash prove that sophisticated market participants don't believe the crash reflects reality. 63 tons of gold standing for delivery while prices fall is unprecedented. It reveals a complete disconnect between paper pricing and physical demand. When wealthy entities and institutions are demanding physical delivery during crashes, they're telling you the price is wrong. Number 2, the global premium structure is at historic extremes. 51% Shanghai premium over COMEX, 28% India premium. These gaps don't exist in functioning markets. They exist when price discovery is broken, when paper and physical have completely divorced. The physical price is real because that's where actual transactions occur. The paper price is manipulation because it's set by leverage and forced liquidation rather than supply and demand. Number 3, the lack of short interest despite a massive crash tells you who's selling. Sophisticated speculators aren't shorting, they recognize the danger. The selling is concentrated among entities that need to paint month-end books, not broad market participants betting on further declines. When smart money won't short a crash, it tells you the crash is artificial. Before we close, consider subscribing for continued analysis as this situation develops. The follow-up, covering how these delivery volumes resolve and what happens when month-end window dressing ends, will be crucial. Also, join the discussion in comments. Share your perspective on what you're seeing in your local markets. I read every comment and often incorporate questions into follow-up content. For those who want more detailed analysis and data, consider supporting through channel membership. The final thought I'll leave you with is this. Markets are teaching us in real time what happens when paper pricing mechanisms try to suppress prices below what physical buyers believe reflects reality. The lesson is clear. Paper manipulation can work temporarily through leverage and forced liquidation, but physical reality always wins eventually. The only questions are timing and how violent the convergence will be when paper is forced to meet physical. Right now, we're witnessing the early stages of that convergence. Paper markets are showing extreme stress. Physical markets are showing extreme tightness. Delivery volumes are breaking records. Global premiums are at historic levels. Major institutions are simultaneously selling paper while recommending long-term holds to clients. The contradictions are becoming impossible to maintain. What happens next depends partly on whether investors understand these dynamics or panic based on paper prices. If enough people panic and sell physical holdings because paper prices are falling, it extends the manipulation by providing the physical metal that paper shorts need to deliver. But if physical holders recognize the game and refuse to sell into paper price crashes, the system breaks faster because delivery demands exceed available supply. This is why education matters. Understanding market structure, recognizing when paper and physical divorce, knowing how to read delivery data and global premiums, these skills separate investors who survive extreme volatility from those who get shaken out at bottoms. The current situation is teaching these lessons in real time. The divergence between $90 COMEX prices and $136 Shanghai prices won't persist forever. The laws of economics eventually reassert themselves. Arbitrage opportunities this large eventually get closed. The question is whether they close through paper rising to meet physical, which is what delivery data and premium structure suggest, or through some other mechanism like exchange rule changes that prevent delivery, which would destroy credibility. Either way, understanding what's actually happening beneath surface price action is essential for making informed rather than emotional decisions. The data suggests this crash is window dressing and forced liquidation, not fundamental demand destruction. The physical market is as tight as it's ever been. Global buyers are paying record premiums. Delivery volumes are breaking records. And these aren't characteristics of dying bull markets. These are characteristics of paper markets losing control. Stay informed. Think critically about what different data points reveal. Don't let short-term paper price volatility override the clear signals from physical markets. And remember that the most important decisions are often the hardest ones, made when fear is highest and prices are lowest. This might be one of those moments where conviction matters more than comfort. Time will tell, but the data strongly suggests that selling physical holdings because paper prices crashed would be transferring wealth to buyers who understand the difference between price and value. Thanks for watching.